All right, let's go ahead. Switched over. All right, cool. Up. How you guys doing tonight? It's gonna be a good class. This is the animating class for it. So appreciate you guys tapping in.
What's going on, bro?
Nothing much, man. Getting it done, man. Here at the office, locked and ready to rock.
Yes, sir. Let it.
Yeah, so tonight, Queens and Kings, this is your trading instructor for Lions Wall Street Trading School. My name is Lionheart Doyle, and tonight we will be covering indicators. In a nutshell, I'll say like this: indicators are one of those things that make life a little bit less complicated when you're looking at the charts. But in a nutshell, what I want you guys to take from this mostly is just the concepts. We're gonna go over next week on how these indicators, like go into depth on how these indicators work. But for the most part, I want you guys just to understand that these indicators are not something you just see one time and then you'll pick it up immediately. Obviously, we're talking about trading. We're talking about investing in the market. People spend thousands and thousands of dollars and go to school for this type of training. And nonetheless, what I want you guys to understand is that getting to at least the understanding of the concept is all you really want to get to right now. When we go to do practical application in the markets, you're going to see that firsthand. I don't use indicators anymore. I'll say like then I'll show you guys why probably towards the end of the session. If you guys have any questions, leave it in the comment section or just unmute yourself, ask me whatever you feel comfortable with. I'm here for you guys. But with that being said, we're going to go ahead and jump right in to our slides real quick. All right. So once again, Lions Wall Street, here for it. You guys have any questions? You guys know where to email me, info@lionheartmotivationfactory.com. You can also hit my hotline, 833-563-4763. Leave a message, comment. You guys want to give me some feedback for the class, that's where you can do that at. And website is up and running right now, so you guys can visit Lions Wall Street if you are interested in signing up. But I'm here for you guys. I want you guys to make money, and I want you guys to make this money by being educated on how to look at the charts, be able to identify opportunities for yourselves, and these indicators are going to help you do exactly that. All right. So firstly, I'm gonna say what the indicator is. We're just gonna hop right into it, but I'm gonna say what the indicator is. And in a nutshell, I'll say like this. I'll show you an image afterwards. So first, we're gonna go over Bollinger Bands. Bollinger Bands are made up of three different lines, an upper line, a middle line, and a lower line. And all that they show is the volatility, and they show the top of price and the bottom of price. I know it's a lot of words on the screen. I don't even necessarily want you to focus on that. What I want you to focus on is there's a top and there's a bottom and there's a middle. All right. So I'm gonna show you guys exactly what that means, but I am gonna read this just for the sake of if somebody's listening audio wise. Bollinger Bands are made up of three lines: an upper band, a lower band, and a middle band. The middle band is a moving average, and the upper and lower bands are a set number of standard deviations above and below the middle band. All right, that sounds super complicated. When you see this, you're gonna be like, that's it, right? Volatility. The bands are based on volatility of price. When price increases, the bands widen, and when price decreases, the bands narrow. We were talking about consolidation the other day, so you'll kind of see that firsthand. I'll give you, hopefully I can find a good example, live example in the markets. Trend strength, the position of the bands indicate how strong the trend is. For example, if the price are close to the upper band, the market might be overbought. So you're basically, I'm gonna go ahead and move over to the next slide so you guys can actually see what I'm talking about. But Bollinger Bands, what they were just talking about was, say like this, upper band, right? Lower band, right? SMA, well, smooth moving average on this one, but it's an EMA is the middle band that you're seeing going through the candlesticks. And this is just kind of a representation. Don't worry about the price and all that. What you really want to focus on is the fact that if price is near the top of the Bollinger Band, that means it's overbought. If it's under, like close to the bottom Bollinger Band, lower Bollinger Band, that means it's oversold. And that means that there's opportunities in the market. What I want you guys to also take away from these different indicators, you never want to get in on a trade by just looking at one indicator. When I talk about areas of confluence, you want to use these indicators that I'm teaching you collectively, not solely just based off of what you're looking at on the screen right now. All right. So the next indicator, EMAs. I'm sure you guys heard me talk about it. This is one that I do actually use every day, and it's basically because it stops me from having to go all the way back in history when I'm scrolling and sliding to the left and right on the charts. It stops me from having to go all the way back. So let me actually pull this down for a second, and I'm going to give you guys an actual example of Bollinger Bands. Give me 1 second so you guys can see. That's exactly what I'm talking about. Escape. Now hop in trading view. All right, cool. My trade's going good. That's always good news. All right, let's see if we can find some Bollinger Bands. So when you're on trading view, go right here to the indicators. And what you guys want to know is there's multiple types of Bollinger Bands out there. You find the one that works for you, the one that you like. But at the end of the day, you just kind of want to get the one that you're comfortable with. As long as it's doing its job, it doesn't necessarily matter. All right, let's go to a whole nother market that's not marked up by me. All right, cool. Yep. Looks crazy. And this is one of the reasons why I don't like to teach with indicators, but I do want you guys to know how to use them because at first it looks crazy. If I had all these indicators on at once, you'd be like, what the heck is going on? But if you break them down and you understand what they are individually, it actually helps out. So let's go ahead and get into the Bollinger Band real quick. I'm gonna give it like a 2-minute spiel. All right, so we got the upper Bollinger Band, we got the lower Bollinger Band, and then we got the bad boy, the SMA, EMA, Exponential Moving Average, riding through the middle, right? Now, just because if I'm solely only looking at this Bollinger Band, trying to basically see when it's overbought, right? Because it's at the top of the Bollinger Band versus oversold,
boss.
top of the bottom of the Bollinger Band. These are all different things that you guys. Was there a question?
I can't see your screen no more.
Oh, my bad. Thank you. Because I was going in, man. I was going in. Goodness gracious, I was going in. Where's the share? Zoom is never, there we go. All right. And I do see a comment in the section, so give me 1 second. Let me see what we got going on there. All right. Can you guys see my screen now?
All good.
Okay, cool. Give me 1 second to look at that comment. But what I was saying was, so far as Bollinger Bands, it looks crazy right now. If you're first time ever looking at charts, you're like, what is this? All these lines and stuff. But all you're looking at is this top Bollinger Band, the upper Bollinger Band, this lower Bollinger Band, and then EMA in the middle. And actually, let me get my EMA out of there. So clean it up just a little bit. Oh, nope, then wrong one. That back on there. Yeah. Okay. So basically what we're looking at is overbought right here. Price goes up, and obviously you see some rejection, meaning it's overbought, too much buying going on, too much buying action. Obviously, we just came off a trend right here, expansion, right? If you're looking at market structure. And then from there, we got overbought, so oversold, right? Here at the bottom. And so when you notice, like, you can have a strategy. Like I said, you don't need a lot of areas of confluence, but if you do have a strategy where, hey, it's matching the trend lines that you drew, matching support and resistance, and it's hitting one of the Bollinger Bands bottoms, that's clearly a sign of an area of confluence. And you would probably get in right here and ride that thing up to the top and then get out. So this is a good indicator for you to understand what's at the top, what's at the bottom, and when you should start looking at an exit and out of getting out of the market, basically. All right. Any questions on that one? And then let me check these comment sections. I can't look at the, so no, do I have to stop sharing to look at the comments? Hang on 1 second. Okay, cool. Yep, can't see. Got it. Yep. So we're there for it. All right. Cool. So that's the Bollinger Bands. We're gonna take that one off and go to the next one. Give me 1 second. Let me share my screen again. All right, Bollinger Bands. So once again, if you guys have any questions about this, just let me know. We're gonna move to my favorite. What I always use is EMA, Exponential Moving Average. I guess I could have spelled that out for you guys. Basically how it works, the EMA is a weighted average meaning it gives more weight to the recent price data. The EMA is more sensitive to price changes than a simple moving average. I call it smooth moving average, but a simple moving average. The EMA is a lagging indicator, so it's used to confirm trends that have already started. All right. So it's one of those things where, let me go ahead and pull up this, give you guys a better example. All right, so an exponential moving average. If it's a 200 EMA, that means it's the representation of the last 200 candles. You got me? And so if you can see where the line is, let's say it's the 200 EMAs, it's a dark blue line, right? And if it's right here, that's where the price is, right? Whatever, if this is 27.90 on gold or whatever we're trading, right? If it's 27.90, that means 27.90 is the average of the last 200 candles because it's the 200 EMA. All right. Ideally, when you see EMAs cross up and down over each other, that's a sign to get in. Exponential moving average shows the upward trend faster than does the simple moving average, and it's one of the reasons why I don't use simple moving averages. I use the exponential moving average because I say like this, it's going to cover more information. All right, it's going to cover more information. It's based off of where the line is on price. So if price is all right here, right? If price is all right here on the right, then your EMA would be wherever this is at, the price of wherever this is falling in at. All right, let's look at that on real time. All right, so I'm gonna take this off, take the Bollinger Bands off, and add the EMA. All right, so this is an EMA. This is the 9 EMA. So right now it's all the way up there because price out of the last 9 candles on average is up here. You got me? So this is a huge indicator that we're in an uptrend. If you see the EMA or the EMA that you're using, let me use the EMA I actually use so you guys can get a better understanding. This is the EMA that I use, right? So the first one is the 21 EMA representing the last 21 candles, the average of the last 21 candles. The second one is a 55 EMA representing the last 55. And then we have the 100 EMA. If you look right here, it's all broken down right here, right? And then the 200 EMA, and it even has a smooth moving average or a small moving average, right? So in a nutshell, the way that you use this is, as you can tell, maybe you can't tell yet, but you'll be able to tell here shortly as you apply. When price comes down to a moving average or EMA, you'll see that it respects the EMA, and if it goes under, it'll come back up because of the EMA. It's the average, and basically when everybody's seeing the same information, everybody is using EMAs if you're in the market, right? So if you're using EMAs in the market, obviously everybody has the same psychology, and they're saying, hey, when price gets too much past the EMA, it needs to be pulled back up, right? And if it was a Bollinger Band right here, I can guarantee you that the Bollinger Band would probably fall somewhere right here saying that it's oversold, all right? So let me see some areas where it respected the EMA. Let me go back to gold. Gold does a great job of respecting the EMAs. So you'll see it come down, drag across, and as soon as it goes under, you see a whole bunch of price rejection, right? The wicks on the candles, price rejection, heading back up, heading back up, heading back up. And as soon as it comes back down to the EMA, price rejection, right? Head back up, right? So I hope you're starting to see, and like I said, you can't use any of these solely because let's say right here, right? It breaks this yellow EMA line, right? And it comes down. So that means it's going into a downtrend. Because if it's breaking the structure that or invalidating your trading plan or your trading strategy, this would mean that it's in a downtrend right now because it literally broke past the EMA and kept going and kept going and kept going. And so that's why you can't use any one indicator to hop into the market. All right. Any questions about the EMA, exponential moving average? All right. I head over to the next one. All right, so this one is a stochastic oscillator. Stochastic oscillator. A stochastic oscillator is a momentum indicator comparing a particular closing price of a security to a range of its prices over a certain period of time. The sensitivity of the oscillator to market movements is reducible by adjusting that time period or by taking a moving average of the result. It is used to generate overbought and oversold trading signals, utilizing a 0 to 1 bounding range of values. All right, now clearly, like, what the heck does that even mean, right? We're gonna go real time after this example, but this is a stochastic. We just say stochastic. You don't got to say. I call it Stokey. That's my nickname for it. But in a nutshell, it's just another indicator to let you know when things are overbought and oversold, right? So it also lets you know when you are using your stochastic, how much volatility is in the market, because it's always going to fall at the top or the bottom for overbought and oversold, right? So you can use this, you can use the EMA, and then you can use the Bollinger Bands to also verify that things are overbought or oversold. And so, if in a nutshell, let's say you just got in at the bottom because it's oversold and you got in for a buy right here. When it gets to the top, you would know that you need to start looking for an exit point. Maybe you start seeing some resistance, repeating retesting, right? This is probably retesting right here if we're talking about charts, right? Retesting, and then it's coming back down. And if you look at these waves, they coordinate with the candlesticks above. You got me? And so it's a way to understand the volatility, how volatile the market is. When this meter right here is on the higher end, all that means that there's more buyers and sellers in the market. When it's at the lower end, that means there's not a lot of buyers and sellers at the market. All right. So something to think about, and another something you can use to hop into the markets.
So is this view right here is the same thing that's on Trading View?
Correct. So I'm gonna go ahead and go live time. We're gonna go live, and we're gonna pull up a stochastic. So let's get this one.
And we still focused on gold, correct?
Yep. And it's the same thing in any of these markets, right? Same thing in any of these markets. But in a nutshell, let's see if we can. Let me pull this over a little bit more. All right. Cool. So if we're riding this, if we're looking at the stochastic and we're seeing how it's matching what's going on currently, this is obviously meaning that, see the 80 right here, the meter right here, high volatility, 0 is lower volatility. And so in a nutshell, when it gets too high, it's going to start to tank, and it's going to be because it's overbought. It's overbought. So you'll start to see it come down, and because of there's less buying, there's the meter is going to go low. So if it's right here and you track that over, it went from 80, from being all the way at the top of the stochastic indicator, to start being in the middle. And obviously you can't expect it to just go up and down like a smooth it's not going to be a smooth wave every time. Sometimes if it's riding a trend or something, then it's gonna stay riding a trend, and then it's not going to be riding a trend. So once again, you don't want to depend on any one indicator. All right. So here's what this looks like. All this is a representation of the candlesticks up here. So as price came down, right? Came down right here. Came down on the stochastic, came down with the candles. It was oversold at that point. Now it's time to start buying again, right? All the way to this point. Got the double top for the candles, right? Came back down again because it's overbought now. And so, like I said, it's just an indicator that you can match with the price. And obviously it's more of a confirmation, a trending confirmation. When you think that the market is trending, you can look at the stochastic, or you can look at the EMAs, and it just basically can tell whether it's trending or not trending. It's a confirmation of a trend. You got me? So it's a lagging indicator as well. So just understand that it's always going to be a second behind, but nonetheless, it's price representation. All right, as you go on. So right now, it's currently right here. So that means it's not a lot of buyers in the market, not a lot of volatility going on, not a lot of buyers and sellers, and not a lot of traders is how you want to look at it. Not a lot of traders in the market. Now, if it was up here, sometimes it might reach 100 and go all the way up here. This line might come all the way up here. That means it's a lot of people in the market, and it's also overbought. You got me? All right. Any questions about that indicator? All right.
Oh, you good.
Got a question?
No, you good.
Okay, cool. All right, going into the next one. All right, MACD. All right. So MACD, is another indicator that offers a visual representation of the ups and downs in price action as influenced by market volatility. The idea being that once the indicator has signaled a significant change in the market behavior, turning from bullish to bearish, for example, or vice versa, you have a potential entry or exit point for your trade. MACDs are very good at understanding when obviously price done dropped, went up so high that now you start to see some consolidation. And then let's go ahead and go not real time yet. Let's look at a example. But price goes up so high at some point in time, it's going to become bearish, and then it's going to start to cross over. And what you want to look for with these MACD indicators is the crossover. Whenever the line is crossing down, that means bearish action is starting to happen. It signals a selling initiative, a selling downtrend motion. That's basically what this is representing. Now, when it's a bullish crossover, all you're seeing is the different lines that cross over and up. And then in a nutshell, this is the time to get in for, if you see right here, this is time to get in for buy and ride it up until you start to see it start to die down. The trend is starting to die down, right? Then you get out, let it go down, ride it on up, same thing. And you use this in confluence with the other indicators. You got me? If you notice, some of these indicators are, they're a little bit redundant. So let's go to the MACD on. All right, let's go to the MACD. Why does it look like that? That one looks completely different, but no, we're not. There we go. All right. Nope, not using that one either. Give me 1 second. I don't like this MACD indicators. It's a little more complicated than it needs to be. Give me 1 second. So whenever you have, and by the way, MACD, sorry, stands for Moving Average Convergence Divergence, meaning all that it's going up and down is convergence and divergence. It's contracting and crossing over each other. That's all you want to really know about the MACD indicator. And don't, like I said, don't worry about understanding every single one. Just understand the concept and what they're for. As you start to do practical application, you'll start to see how they help out. You don't need all these indicators. I'm letting you know that right now. Kane, when you see me trade, I'm not having any indicators, right? I might be using an EMA, but that's about it. You don't necessarily need them. You just need to know what's going on. When you really fully understand market structure, you know what's coming next. It's only a matter of time. You got me? But these indicators are to assist you. They're not to be solely relied on. All right. So let's see if I can find a second. Goodness gracious, they always want some money from me. Let's get rid of this one. 1 second. What? Took it off. What are you talking about? All right. Nope. We're still. All right. Let me take off another one. Oh, probably maybe because I already have it on there. Okay. So work. There's all right. Bulls crossover RSI. So let's look at this one. See, this is not what I really want. Second. I'm trying to find the right MACD. I haven't used the MACD in a while. Once again, it's not something that you absolutely need. There we go. I think that's the one I'm looking for. Okay. Cool. Perfect. Yep, that's what I'm looking for. All right. So this is real time what a MACD indicator looks like, right? This one, let me get rid of all the other ones. 1 second. Because at some point this just looks crazy. All right. I'm gonna get rid of that. All right, boom. All right, now, so this is a MACD indicator. It represents how much momentum is in the market, and if you look at the green, all that means is it's more bullish momentum. If you look at the red, it's selling bearish momentum. All right. Now, when they cross over, right? This is a crossover. It's a representation of exactly where the price is. So when it crosses down, that means it's going into a bearish crossover. When it crosses up, right? Same thing. It's going into a bullish crossover, going up. You got me? And so once again, if a lot of people, they get in right when it crosses or when it's starting to cross, because what it could do is something like this: cross over and then cross right back over. So that's another reason why you don't want to solely depend on any one indicator. You got me? But it is a good sign to confirm whether something is going into a downtrend or an uptrend. If you're like, oh, this looks like it might be going into a downtrend, how can I confirm that? I'm going to look at my MACD indicator, see that the crossover is bearish, and then I'm going to go in for a sell and ride that thing down as low as possible to the bottom and ride it back up. When I see a signal like this, a doji candle, right? I think they call that a butterfly or a morning star, I want to say. But nonetheless, no, it's not a morning star, doji candle. But anyways, it's a type of doji candle. But nonetheless, this is exactly where this is happening at, right? And then I would try to ride it right here. See that maybe it's on the stochastic that it's oversold, and then I would go ahead and go all the way, go in first buy and ride it all the way back up. You got me? So that's how this MACD indicator is being used. All right. I'm gonna go to the end of it so you guys can see what the end would look like. Oh. So I'm trying to get to the end. I don't even know how I made it back over there so far. Goodness gracious. Sheesh. Okay, cool. All right. Oh, quick little what's the name? If ever you are back behind, if you hit this little button right here, it'll go all the way to the front to where price is currently at. All right. Boom. All right. Any questions about the MACD indicator? All right. I believe this is the last one we got. The Fibonacci. All right. Fibonacci. Reminds me of the Da Vinci Code, something like that. But all right. So how it works, the Fibonacci. It's a sequence, is a series of numbers where each number is the sum of two numbers before it. The sequence is 0, 1, 1, 2, 3, 5, 4, 13. I'm not even going to I'm going to show you how simple this is to look at. The Fibonacci ratio is the value of any number in the sequence divided by the number before it, which is approximately 1.618. There's something about 1.68. It's supposed to be like a universal code, and it's really interesting how it goes across so many different things outside of trading. You would have to like, I would Google this if I were you and to see what 1.618 can cross over to in so many different things outside of trading. It's something about it's like a magical number, one of those universal numbers that it just is. All right. So the Fibonacci indicator creates levels by drawing lines between two significant price points, such as a high and a low. The most common Fibonacci levels are 23.6, 38.2, 50%, 61.8, and 100%. All right. Now, it's a Fibonacci is an indicator. It's for your technical analysis. It's a technical analysis tool, and it helps you understand the sequence. And you're supposed to use it to identify support and resistance, but also it's great for pullbacks. Whenever you're like, oh, I don't know how far the market's going to pull back, you want to pull out the Fibonacci in order to do that. Me personally, I just go off of support and resistance. Like I said, I'm a discretionary price action trader, right? So I'm just going to go off of wherever I see that the last support is. And if it goes past that, then I'm just going to see where the next area of support is. If it goes below that, I'm going to see where the next area of support is. You know, I might take trades all the way down on each one of those, but that's not the best way to trade sometimes. That's just one of the strategies that I use depending on what's going on in the market. All right. So you see this yellow line here? Let me put up. So this yellow line, you would basically open up your indicator and identify pullback. So 61.8 is a great area that most people get in at to basically, let me back up. If I'm trying to find where the next pullback is, and I want to see where the market has basically went down 50 or pulled back 50%, this is what you use this line for. If it pulls back 23%, I'm hoping that makes sense. I feel like this indicator is a little bit different, but this is multiple different Fibonacci's. You got me? So you use this with trend lines, and basically, if you'll notice that when you have a trend line, it'll be at one of these levels for whatever reason. You know, who's to say? But 61.8 is a good pullback area for you to hop in the market and hop back in. So let's say use the 61.8 area to hop in the market along with the MACD because it's over oversold, time to get in for a buy, right? And then the stochastic is also saying that it's at the lower area oversold as well too. Those are three indicators on top of your support, on top of your resistance that you drew up to get into the market for a buy. All right. Let's look at that real time. 1 second. See, I'm gonna have to get rid of this MACD. Strategy. Yeah, let's get rid of it. 1 second. All right, this is the last one right here. We just hit 7:30, so I'm gonna get you guys out of here. I ain't gonna make it like church. You know, church be holding you on a little too long, trying to collect extra set of tithes and all that. And that's now you ain't nothing wrong with extra tithing. All I'm saying is that I ain't gonna hold your hostage. That's all I'm trying to say. Give me 1 second. All right. So they just have one big extension. See if they pull anything up for me.
Take your time, Pastor.
Yeah, I feel that. All right, no, that's not it. We're gonna go over here. There's the Fibonacci at. There we go. All right, let's do. All right, so where's my candles at? So give me 1 second. Let me back to my watch list. Go to gold. See, there we go. Boom. All right. So now I'm gonna pull out my fib tracer. And if I'm looking for what we call a retracement, basically when the market starts trending, it starts shooting up into the air, I'm looking for a retracement so I can get in at that discounted price that I talk about. If prices are jumping up, I'm not just gonna hop in just because I'm gonna wait for a discount unless it's already took off, and it happens sometimes. I feel like that happened this morning. I was trying to get in for a trade and it took off on me. But this is what you want to use this indicator for. All right, so you would put it at the base. 1 second, let me get rid of some of this stuff, clean this up a little bit. All right. So if you're looking for a bullish, you're going to go above. If you're looking for a bearish, you're going to go below, right? And you're going to put it at the base of whatever your support and resistance is. So if you can barely see, I wish they put it on the right side, goodness gracious. But you can barely see. Let's see if I can stretch this out. All right. You can see the numbers, the 6.18, the 0.50%. It goes the same thing on the other end. But basically how I would use this is if I got into the market and I saw an area where I wanted to get in at, I would basically say, hey, this is the price point where I'm putting the Fibonacci base, and then I'm dragging it down. So once it gets down to 0.50% or 0.168, I'm going to assume that this is where I need to be getting in at right here to get in for a buy. This is not an actual example because it's kind of hard to see it right now. Let me see if I'm trying, man. All right. So let me draw this back up. Stretch this out a little bit so you guys can see this. So you guys see the numbers, right? So if price comes up here and then it retraces back down to about right here, the 0.618, this is where I would be looking to get in, not just solely off of this, but this is where I would be looking to get in for a buy because it's a retracing, a pullback. This is what this tool is for. Obviously, you saw there was a few different Fibonacci's on there. This is a retracement Fibonacci, and all I'm looking for is for it to come, the price to come back down here. I probably would have got in right here, and hopefully it would have went up. You got me off of retracement, but because it retraced all the way down here, it technically doesn't fit this this example. You got me, but I just want you guys to understand how to use it. We're gonna be a little bit more. We're gonna apply it a little bit more next week, Monday, Tuesday. I feel like we should do like 2 days over just understanding indicators. But outside of that, that's basically what you want to use this for. It just lets you know where that discount is and where you should be getting in at. So at 0.5, that's 50% discount. 0.6, it's like how big of a discount do you want? You want the 61% discount or you want the 50% discount? But you're going to base it off of, let's say this was an area of support. and it matches the MACD, and it also matches the stochastic where it says oversold, right? I'm getting in for a buy, and I'm going to write it back up because it's an area of confluence, and there's multiple signs that I should be getting in. It matches my Fibonacci, matches my MACD indicator, what I'm looking for. It matches my EMA also. It's writing on an EMA. That's what you want to be looking for. All right. We'll go a little bit deeper into this a little bit earlier. So I'm going to give you guys some better examples. I just kind of wanted to give you guys a taste of what indicators are, how they are used. But obviously, oh, hold on. I'll pull any of that back. Nope. All right. Obviously, that's what we're looking for when it comes down to indicators. Why? My chart just goodness gracious. Not going to let me get anything. Let me refresh the screen. Goodness gracious. Nope, still doing it. All right. I don't know if it's because I'm on full screen or where everything just went. Feel like it's glitching on me. All right, it's cool. But that's the end of the lesson, Queens and Kings. In a nutshell, that's what you want to be focused on. We are going to be going over the indicators a little bit more. I want you guys to understand that this is something that's going to take some time. Don't feel like you need to know this all at once. And the reason why I don't necessarily teach on indicators up front is because I just want you guys to understand that all you really need is to understand market structure and to understand price. If you understand market structure and you understand price, everything else is going to be solid for yourself. You'll pick up things over time. But if you want to trade with me live, I trade live 9 a.m. Eastern Standard Time. We're making money in the morning. All right. And some of these things you'll see me apply, some of the things you won't see me apply. I don't feel like it's necessary to know all these different indicators. Like I said, I came from using 3, 4, 5 different indicators all at once. One day I was like, it's too complicated, too much stuff going on. You don't know which one is. So you just want to use 1 or 2, maybe 3 at the most, but you're always going to stick to knowing market structure, support, resistance, and just understanding that, things consolidate and things expand. All right. The price consolidates and the price expands. All right. Outside of that, any questions for you guys tonight?
So with the next few lessons, we're gonna be focusing on them indicators.
Monday, Tuesday, Wednesday next week. Probably just Monday, Tuesday. I'm probably gonna have a different lesson to move on into a different segment next week. But Monday, Tuesday, we're gonna be digging in a little bit deeper. Probably go over 2 indicators in depth, and just kind of hopefully we can find some trades. Looking at the market right now, I don't think there's. I'm still in a trade right now for gold. But if you guys are looking to set up your account, all you got to do is go to lionswallstreet.com, and I can help you guys get that figured out. If you don't have your account set up, if you don't know how to fund it, all you got to do is reach out to me, and I'll help you out with all that. Right? Any questions right now?
Nope.
All right. I appreciate you, Queens and Kings. You guys have a good evening, and be safe. All right.
I appreciate you. Have a good evening, man.
Yep. No worries at all.
All right.
Take care.